Hello, good morning, and a very happy new year, listeners. Hope it was a good break for all of you celebrating the beginning of another new year. With the way the world has been moving, I believe we all are having front row seats to one of the most amazing times of financial markets. And with Almus Market Mornings, we continue to bring in narration of the same. Going forward, there are numerous questions we are having. For example, whether there will be a pivot by the BOJ to abandon the yield curve. Will ECB succeed in resurgence of the Eurozone? Will US skirt their way through a recession? JK, as usual, I'd like you to share some wisdom.
Yeah, thank you, and happy new year to all. Yes, these questions have been on the minds of traders for a few weeks now, and probably the new month data will provide some clues in which direction we are moving. But just to get narrow our focus, we had a period of mixed markets in the last 1 week with the trading thinning out, but no fresh initiatives being taken by the traders or investors. Although we did have some data of significance, which markets may take note when they return from holidays. The US Chicago PMI, the barometer of manufacturing activity in the Chicago region, rebounded strongly to 44.9 in December from 37.2 in the prior month. And forecasts were at 40, and it is the last of the regional surveys of manufacturing in the economy. While at 44.9, it's still in contraction territory. The rebound in manufacturing that has been under a slump for quite some time now would be seen by Fed as supporting their stand that recession may be milder than market is assuming and will maintain their current hawkish stance. So there is some possible policy implication if we get more, improved data from US. Of course, we will see the comprehensive ISM and S&P global report in the remaining days of the week to confirm positive development. Then, even as China has been taking steps towards increasing Yuan usage in the international trade settlement, they are reportedly reducing US dollars weightage in the currency basket, from 19.88 to 19.83 for the dollar, and even euro from 18.45 to 18.21. And this means the moves in euro and USD will have lesser impact on the yuan, which can become more stable. China has already, pitched in for bilateral currency settlement arrangements with Russia and looking to have oil priced in yuan by the Middle Eastern nation. So this can be a factor that will guide the dollar overall direction, because people may need to have less of dollar reserves if these things become more entrenched. India also posted a current account deficit of 4.4% of GDP for July-September quarter, which was the highest in terms of absolute amount at 36.4 billion since the third quarter of FY13. Of course, of more significance would be the BOP, which the balance of payments, which recorded minus 30.4 versus 31.2 billion surplus last year for the same quarter. So while market has been expecting BOP deficit for the year, for the rupee trend, it's very critical to see whether foreign inflows take a positive turn for the year. And having seen a net outflow of 16 billion in 2022, so such a development, without such a development, pressure to weaken rupee will increase, as RBI would like to maintain reserves at a threshold and use exchange rate to balance the deficit. The question about flows remain as global financing conditions are still tightening. And this is irrespective of the fact that dollar continues to trade on the weaker note. Today, we have had a significant break in the dollar yen of 130 psychological mark, and then yuan breaking 96.90 level. And not sure whether rupee will take too much of cues from this, because the deficits and the flows remain the dominant factor as far as the rupee is concerned. Of course, India's domestic factors have been quite positive. The latest evidence coming from GST collections for December touching almost 1.5 lakh crore, jumping 15% compared to a year before, and 2.5% more than that in November as well. With direct tax collections also showing a good jump in December quarter. Fiscal deficit seems well contained with budget estimates. That's a good macro development for India. And then the core sector output in December showed 5.4% increase year on year, which bodes well for the industrial output number coming on January 12th. Notwithstanding higher inflation and higher rates, India's major stock indices have gained nearly 5% in 2022 compared to global index losing 20%. India's growth rate has been relatively high and expected to remain so for the next year as well. The PMI of Indian manufacturing announced yesterday showed increase to 26-month high of 57.8% in December, marking the highest increase in new factory orders and production and in more than 2 years. So going forward, it's important to see whether these strong domestic fundamentals and growth prospects attract foreign investments, which have been missing for quite a while. A turnaround around in the flow pattern will bode well for the rupees prospects for the year. Of course, technically, we are watching the 83 psychological mark and as well as the 82.40 as resistance and support respectively to get a direction. The dollar index, which had gained 20% from last year, but from the close of 2021 till September of 22, gave up half of it by December in sharp correction on markets starting to moderate on Fed rate hike expectations. The sharp downswing in the dollar in the last 3 months is likely to get corrected in the short term from current 103.70 or even after falling to 102 levels before we get a fresh clue about Fed's monetary policy update. Euro and GBP particularly can correct their recent strength. Yen is likely to gain more as Japan has just started to move towards normalization of policy. The first week of the year kickstarts with quite a bit of data from Europe and US. In fact, the PMI manufacturing survey from Europe announced yesterday has already shown some positive indication. And one more positive development for Europe has been the fall in natural gas prices to a 10-month low. And that means it's now trading at a level which was ruling before the Ukraine war. We have the manufacturing and services PMI surveys from S&P as well as the ISM for US. Then we have the ADP, JOLTS, and the NFP data, all of it indicating the employment situation in the US, which is very important as far as the Fed policy is concerned. So all in all, we are not now getting back into a lot of action. We might see big swings. We've already seen some swings today, and the initial swings can actually be misleading. So we keep our powder dry and try to work for more sustainable strength, about which will give you our updates going forward. Thank you.
Thank you, JK, and a lot of updates. And as markets come back from the holidays, as you mentioned, there is a rebound in manufacturing in the US. And will the narrative of a soft US recession drive the dollar in 2023? Of course, it's a question that will be answered by time. Chinese Yuan basket also saw a reduction in the dollar weightage, while for India, the domestic fundamentals remain strong, and whether foreign inflows will arrive, and till the time they arrive, rupee will be under pressure. That's it for today, folks. We are already seeing some moves happen with CNH and Japanese yen at the start of 2023. Keep managing your risk. That's it for today. Thank you so much for listening.